Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at Twitter, see what people are talking about, see what information they're sharing about commodities and or the stock market. Obviously, I'm going to interject my financial opinions along with it, and I will also share perhaps some information of what I am seeing and where I think we are in the bull market, which is still very young in my opinion. So let's dive in here and let's look at some information and see what's going on. Again, if you want to follow me, it's at finding_finance. And if you want to be a part of our community, it's finding-value.com. Says housing is crashing really hard. So Connor says, trying to find a house in 2023, a line out the door for an open house. I think I'm just going to take my wife and baby and move back in with my mom. Sadly, I hear there's already 5 similar offers. Yeah, huge recession here with the line of people waiting to go in to see an open house. Now, yes, it's circumstantial kind of evidence. It's kind or just I don't know. I mean, to me, the housing market is holding up all right, at least from an inventory perspective. And if this is what's showing up, I don't know if we're getting that crash slowdown that some people think is going to happen in the housing market. It seems like a lot of people do not like me talking about housing and saying that housing is strong. I don't know why, but I don't know. It doesn't seem to me like this is a gigantic housing market bubble if a lot of people want to purchase and there's nothing to purchase. Coming on down, it says 1970 and 2000 both were times where for the next decade metals surged while equities languished. And these were also commodity bull markets. He says, Tavi, this analysis should be in everyone's mind. The tech sector's outperformance compared to the broader market has never been more extreme. As shown in the chart below, the ratio between tech stocks and the S&P 500 is now over 2 standard deviations above the historical mean. During other times when this indicator also reached such levels, the tech sector significantly underperformed in the following decade. It's unlikely that this time will be any different. When discount rates experience a structural increase, valuations become more important, particularly when fundamental growth becomes stagnant. So this is the chart here. It's U.S. tech versus S&P 500 back at February and January 70 levels. So 1970 was the beginning of a commodity bull market, and these valuations changed over that time frame. That time frame, at least in the 1970s, we had a 1970s housing market, real estate market. We had the demographic come into home buying years. We had inflation from that demographic in the homes being purchased, and we had an increasing interest rate environment. And at the beginning, we had peak oil of the United States. 2000s, it was a similar setup with the same outcome. And today, we also have a very similar setup with tech stocks being expensive to the S&P 500. And whenever we get these types of anomalies or movements, that's when commodities have outperformed, is at these 2 standard deviations. So what we should see in this bull market is we should see technology companies laying off people. We should see them struggling. We should see their earnings decline and their chart patterns look like crap, putting in topping patterns. Conversely, we should see commodity stocks bottoming, putting in basing patterns, and starting to move higher if the next decade is going to be such. Coming on down, let me go back out of here. It says the natural gas share of fossil fuel consumption, coal and gas, reached new multi-year highs yesterday at 76%, up 11% versus 2022 thanks to the coal to gas switching. This will yield big year-over-year power burn gains this summer as temperatures heat up, on the order of 4 to 8 billion cubic feet per day. So we can see gas share of fossil fuel consumption is increasing. So we're increasing demand for natural gas as natural gas remains cheap. and that will eat through our inventory levels quicker as people switch to natural gas. We've got, so I have a post that I wrote here and released. It says, after wave one and the bottom of wave two, which is known as the bear trap, of last commodities bull market, almost all of the commodities went up together. Precious metals also increased as well. We are in that same location, question mark. Between the green lines, you can see how things linked up. In oil, we were at wave two. Gold is sitting on top of its pattern. Silver broke its downtrend, but lagging behind gold. Copper sitting on top of support. Federal Reserve, I dare you to print money, lower interest rates, or any other loosening. Commodities are in position. So here's crude oil. Between the green lines, this is the last bottom of the bear trap in 2002. Then we had a move higher of both gold and oil and uranium and copper and all of these different commodities. Are we getting close to the bottom of wave two where we could rip in wave three? I think we're close, but we could be off a little bit and we could maybe get a little more of a flush out in the system, possibly. Doing the short term, yeah, it's always the most difficult to get the short term right, but I still think it looks very good. If you look, we've got that same similar alignment where oil's bottoming on its breakout, if you put it on logarithmic, and gold's already starting to move higher. And crude oil generally lags gold a little bit. So hopefully we're there. This is gold breaking out, sitting on top of its pattern. It's a big pattern. It's a cup and handle, and this is the handle that we've broken out. We've got silver breaking the downtrend line to the upside, and we've got copper sitting on top of support. Those are all in position for a potential move higher. So I'm not in the bear camp, guys. I'm just not. Yeah, we could have a short-term little flush out or something, but I don't think it's going to be sustaining. I could be wrong. Maybe there's something, but I'm riding through it. I've got my shares. I'm playing the long-term decade run. Coming on back. I've got crude oil. So crude oil prices look to be putting in a retest of a breakout. This looks bullish, which usually signals higher yields. I also put last bull market's fractal overlaid on the new wave 1-2 pullback of the current cycle. This would be the projection if the fractal plays out like the mid-2000s. So I took the fractal of the mid-2000s. I aligned the beginning of this bull market with this one. And again, guys, this consolidation is also found in this portion over here. The fractal is the exact same. I lined up the move higher to the pullback of 53%. I lined it up, and then the pullback, and then this is what came after. This goes all the way to $500-something a barrel of oil. That is what it would do if the fractal was exactly the same and the price increase was the same, with the first leg being matched together. So oil would go to $500-something if that were to all match up perfectly. Now, that's not my projection. That's just what it is historically. It's not my projection. It's just throwing the fractal up there and overlaying it, and that's what I get. I don't know. I mean, that's what it is. So that is a possibility. We've got yields here. So interest rates setups. So TNX is the 10-year yield. TYX is the 30-year yield. We have the 2-year yield. And then we have DXY, which all give us a piece of information about the current market conditions. I said dollar against support coming from the top side down, potentially higher on a bounce. If so, that means higher yields, which agrees with the TYX chart, and TNX, which is also against support. The 2-year yield looks like it's putting in a head and shoulders short-term top and could head lower potentially. What do you think? These movements all have a large impact on how assets get priced in the markets. Higher yields typically lead to higher DXY and lower precious metals prices. A curve that normalizes and yields fall will shoot precious metals much higher. So on the 30-year yield, we have a massive breakout and a consolidation and a potential move to the upside, which means yields could continue higher, leading to higher interest rates. And higher interest rates will price technology stocks lower. Commodities won't be that impacted by it. And it's another form of what Tavi was saying in that chart that supports where we are with yield. Yield supports that outlook. TNX is in the same location. We've got a declining interest rate environment. We've broken out to the upside, a new shift to increasing interest rates. We're right on support. Will we keep continuing higher in interest rates? We've got the DXY, which would also support higher interest rates if this bottoms here and starts to move higher. Higher interest rates and the DXY are linked together because the interest rates moving higher is a form of tightening, and a form of tightening will increase or strengthen the currency that is getting that tightening. And then the 2 years kind of almost going in the opposite direction. This is a shoulder, head, shoulder potentially, and maybe we get a pullback in the short term with interest rates going lower before we go higher. And again, that's just looking at the chart pattern. I don't like charting the short term, even though I've got it charted here, because anything can happen in the short term. It's all emotional, news-based movements. The longer term movements are fundamental, driven by market conditions and demographics. So that's what we got there. We've got, so I talked about uranium too. I said URNM and URNJ, turtle heading out of the trend line. Can we gain some momentum here? So moving on up for URNM, turtle heading out of its trend line. We've got URNJ doing the same thing. And I like seeing things align like this. I very much do. And then we got URNM on a longer term perspective so people gain the perspective. And it looks like we're in that dead period, potentially. Could we still get a flush out? Yes, it's still possible. But things are heading on up, and maybe that momentum can carry us higher. So here is gold and silver miners don't look too bad. GDX is playing with its upper kind of flag pattern. We could be breaking out soon. We've got GDXJ that doesn't look too bad. It looks like we're starting to turn and roll back up higher. Not looking too bad. SIL, which is the larger silver companies. Maybe a little bit more work, but doesn't look horrible. We're getting some buying pressure over here. And then we have SILJ that's breaking its falling wedge to the upside. That's also positive. So it's looking positive in the gold and silver mining space. So let's talk about XAU. Gold miner index XAU is close to breaking out against gold. And gold has broken out against the USD. The question is, do you think gold is going higher now, or do you think a large pullback will occur first? The question I asked there is linked to these yields. If yields go up, I think we're going to get a pullback in gold. If they continue lower, even in the short term, I think this is all going to break out and move higher. But the XAU to gold ratio looks fantastic for a move higher. It looks really good. And if we can break out of this downtrend line, oh my gosh, guys, gold and silver mining companies will be one of my favorite spots to be. Gold's already broken to the upside. It's broken out to the upside, signaling that we should see gold strength over the coming 6 months, year. So, or longer. So that's looking good. Coming on back. Of course, I hit something wrong there. So coming down. Here is home prices. It says, since 1976, mortgage interest rates and home price appreciation have had a positive but weak correlation. That is, higher mortgage rates tend to occur alongside higher home price appreciation, but it is a weak tendency. So here's the scatter plot of changes in mortgage interest rates and changes in home prices are weakly correlated. The correlation is only 0.165. And what it's saying is, as home prices go up, we see a tendency of interest rates to also go up. So we see a weak correlation to that. So that's what we're seeing there. So we're slightly scattered to the right and slightly scattered up for home prices in relationship to interest rates. Because a lot of people are telling me, oh, if interest rates go down, home prices go up. That is completely false. That is not a true statement. Because when interest rates go down, generally it's a housing market crash, and rates stay low when home prices recover very slowly. When home prices start to increase rapidly, that's usually when interest rates go up, and they go up together for a while. We've got the U.S. Bank in slow motion continues. U.S. bank deposits fell by $12.5 billion in last week. So we're still in this slow motion commercial bank deposits starting to come out of the system. Then we've got units under construction drive construction employment, not starts. Units under construction still at all-time high. So we still are constructing homes at an all-time high for residential units under construction. But our housing starts has declined a little bit. We've had a little pullback. Is this pullback analogous with this 2001 pullback, where interest rates were going higher? We had a little pullback, and then they lowered them, and they went higher again. We'll see. We'll see. I don't know that, and we can still monitor residential units under construction. If they're under construction, that's what employment is following. It's the ones under construction. Here's the key to investing risk. It's largely a matter of opinion. I like that. Crude oil might be sniffing out the abyss of the recession, the bottom of the recession. So what he's got here is, watch here, we could be bottoming. This is the trend line that I drew as well. We're doing a retest move, and we could get a breakout here. If we get a breakout here, we could see that everything rally as well. Crude oil, copper, maybe gold and silver jump alongside, and that's that everything rally or the melt up in commodities that we've been looking for wave 3. That also correlates, let me go back here, that also correlates with this green line. If I were to put gold in here, it's that move that everything goes up together, and it's the bottom of the bear trap. So he's talking about sniffing out the abyss of the recession, the bottom of the bear trap. So he's also seeing it. We've got inflation-adjusted new home prices continuing to move in this stair-stepping pattern higher. Maybe we go down a little bit, maybe we don't. That's home prices versus consumer price index. It says you guys all got way too bearish. They promised me a recession, but all I got was a regional banking crisis with a lot of inflation. That's right. It says nothing to see here, just another massive base morphing into existence for uranium versus the SPX. Yeah, this is looking good, guys. I mean, it's a double bottom. You got the lead-in pattern here. This is your top. We're right. Basically, we're gold to SPXs, gold to the M2 money supply. They're all aligned. Uranium versus SPX. We're bottoming out. You got to be really patient here and just let this make you money on the upside. It's going to be a big, long bull market, guys. It's going to take some time. This could be a decade plus. You just sit in it. How hard is it to sit in it and not do anything? Apparently very hard. Here's gold. Gold is in ascending from its decade plus rounded bottom. Similarly to its price action in 2005, this time around a false breakdown was thrown in last year. Will we see another raging bull over the remainder of this decade? Yes, we are. Cup, breakout, and here we are going higher again. The everything move higher. It says, would you rather retire at 50 with near certainty you will never have to work again, or would you retire at 45 with a 5% chance you might have to work a few years at Trader Joe's when you're 55? I would take the retire at 45. That's me. So here's rig count. Drilling rig count in America accelerating its free fall as current oil prices are not supportive for high cost and high decline shale wells. capital discipline paying its part, and each rig drop compounds legacy declines and restricts growth, especially given Duke exhaustion. Drilled uncompleted wells, exhausted, rig count falling down, eventually prices will go higher. And that's what we've got for today, guys. So we'll end it there. Hopefully you guys enjoyed it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you want to join our community. And we've got next week, Saturday, 7 a.m. Mountain Standard Time, question and answer session. That's all I've got for today. We'll catch you next time. This is Finding Value.